A single expiring insurance contract collapsed a $10 billion finance empire and dragged in a former British Prime Minister. In the world of high finance, there is a concept called supply chain finance. On the surface, it is a boring, helpful tool. It helps a small supplier get paid today instead of waiting 90 days for a giant corporation to settle an invoice. But in 2011, a financier named Lex Greensill took this boring idea and turned it into a $10 billion empire. He didn't just move money, he moved the goalposts of risk. By the time the world realized what he was doing, he had managed to entangle himself with some of the most powerful people in the British government, including a former prime minister. This is the story of Greensill Capital, a company that grew by treating future promises as current cash, until the promises stopped being believable. To understand how Greensill worked, you have to understand the mechanism of reverse factoring. In a normal world, a supplier sells a product to a buyer and sends an invoice. The supplier waits for payment. In reverse factoring, Greensill steps in. The buyer approves the invoice, and Greensill pays the supplier immediately but at a slight discount. Greensill then collects the full amount from the buyer later. It is a win-win. The supplier gets cash now, and the buyer gets to keep their cash longer. But Lex Greensill wanted more. He introduced something called future accounts receivables finance. This is where the story turns from finance into a gamble. Instead of lending against an invoice that already existed, Greensill began lending money based on the expectation of future sales. In some cases, they lent money to companies based on revenue from customers they hadn't even acquired yet. One example was Bluestone Resources, a mining company. Greensill extended $50 million in financing to them, much of it backed by these prospective, hypothetical receivables. They weren't lending against what the company had sold, they were lending against what they hoped the company might sell. To fund this massive operation, Greensill didn't use its own money. It packaged these loans into bond-like securities and sold them to investment managers. These were marketed as high-yield, low-risk products because they were backed by trade credit insurance. This insurance was the secret ingredient. It made the risky loans look safe to big institutional investors. Credit Suisse managed over $10 billion in funds linked to Greensill, and JM had exposure of around $3 billion. As long as the insurance existed, the system worked. The investors felt safe, and Greensill could keep expanding. While the money flowed, the access grew. Lex Greensill wasn't just a financier, he was a master of networking. During David Cameron's time as Prime Minister from 2010 to 2016, Greensill was suggested to be a senior advisor to the PM, allegedly having access to 11 different government departments. This relationship didn't end when Cameron left office. In 2018, Cameron became an advisor to Greensill Capital and held shares in the company. Reports suggest he was paid over $1 million a year for just 25 days of work per year and may have made $60 million from a listing of the company. Other documents suggest he earned around £7 million from his salary and shares. By 2019, the company was a fintech darling. SoftBank's Vision Fund invested $1.5 billion, pegging the company's valuation at $3.5 billion. Greensill expanded to 16 offices and over 1,000 employees. But the cracks were starting to show. In late 2020, the company began searching for a new auditor because it had grown too large for its current one. But when they approached the Big Four, KPMG and Deloitte, and the firm BDO, every single one of them declined to take them on. The professionals who checked the books saw something they didn't like. Then came the pandemic. COVID-19 devastated the businesses of many of Greensill's customers. Companies like Agritrade and NMC Health began to fail. The house of cards began to wobble. The turning point happened in July 2020. An Australian insurer owned by Tokio Marine Holdings announced it would not renew insurance coverage on approximately $5 billion worth of Greensill-originated loans. This was the killing blow. Without that insurance, the low-risk securities Greensill had sold to investors suddenly became high-risk. The illusion of safety vanished. Credit Suisse immediately suspended its $10 billion SCF funds. As the company spiraled, the desperation grew. In 2020, David Cameron began lobbying the UK government via text messages and phone calls. He was pushing Chancellor Rishi Sunak to change the rules to allow Greensill to join the COVID Corporate Financing Facility, a government loan scheme designed to support firms during the recession. Cameron wanted Greensill to be able to issue government-guaranteed loans. His requests were declined, but the attempt revealed the depth of the entanglement between the former prime minister and the failing firm. The end came swiftly in March 2021. Germany's banking regulator, BaFin, investigated Greensill Bank, the German entity Lex had acquired years earlier. They found the bank was heavily exposed to the Gupta family group, a sprawling collection of steel and metal businesses. On March 8, 2021, Greensill Capital filed for insolvency protection. A $10 billion empire had collapsed in a matter of days. The aftermath was a storm of inquiries. A Cabinet Office inquiry found that a senior civil servant, Jeremy Highwood, was primarily responsible for giving Lex Greensill access to 10 Downing Street. While parliamentary inquiries found that David Cameron had not broken any lobbying rules or acted unlawfully, a Treasury committee noted that the fact he didn't break the rules simply reflected the insufficient strength of those rules. Greensill's collapse served as a warning. When a company treats future hopes as current assets, it isn't financing, it's a countdown to a crash.